Good afternoon, everyone. Our presentation today is really is titled "Selling Your Business in 2026." Um, we're focusing on 2026 because there's probably not a better time, and I've been doing this for 16 years. We had some early 10 years ago, some good times, and then the last few years have been interesting. So this is a confluence of good timing, I think. So we're going to talk about today's M&A market and what it means for business owners, primarily with revenue between 2 and 30 million. That's our company focus. We've sold businesses smaller than 2 million in revenue, but it's really not our target. Our experience over many years has been built in this market range. So this is who I am. I'm the founder of Stony Hill. Like I said, 16 years ago, I started the company to help business owners who I'm a baby boomer personally, and I realized through data I've discovered that there's so many business owners in the baby boomer generation. There's a historical basis for that. A lot of it has to do with the Vietnam War and people coming back and starting businesses. There were 4 recessions in the 70s up through the early 80s, which caused a lot of people to lose jobs. So it was just, and a whole lot of people were born from the quote, that's why they call it baby boomer generation. The population boomed. So there was not a lot of opportunity, but starting your own business. So that's what I've been doing, helping them find their exit, because they're now reaching a point in time in their careers. So it makes sense to consider their retirement and how to capture the wealth they've created. They've spent the last many years building a business, and it's worth something to someone else to continue it on. There's a legacy factor. There's employment issues with their employees. You wouldn't want to close. That's hardly recommended, to close a business that leaves employees on the side. So this is the best way to maintain the business intact and proceed potentially to retirement. I've had a number of careers myself. As you can see, I worked in telecom. I've been in commercial lending. I have my insurance license, so I've been around the horn. Like, I think I understand what it takes. So let me talk about Stony Hill Advisors quickly. We view ourselves as a leading full-service small business advisory firm, and those are all key words, because we have a full service. We're not just selling a business. We actually help people buy businesses, mostly in terms of an exit strategy around making acquisitions that add to the growth of the company, and then exiting subsequently after that. Because the best way to grow your company is through acquisition, literally. Mathematically, it takes 7 years to grow a business at 10% a year, to double a business after in 7 years using 10% growth. If you can buy a business this calendar year yet and double your growth, it's not that hard. There are a lot of people. The purpose of this presentation is to address all the baby boomer generation business owners that want to exit. So some of them may be an acquisition for you if you have time and want to build the value of your company. The value of the company is very much dependent on size. So we are 7 people with our holistic approach to helping business owners. We help them prepare for their exit. One of the things we talk about often is you should be working on your business exit 1,000 days before you are planning to find a buyer. That 1,000-day period, although it's a general number, it's an important time period, because it does take time to prepare a business, and we help coach business owners through that 1,000-day timeline to make the changes, in some cases, to improve the value. It's de-risking. One of the ones I talk about often is, you want to find, in most businesses, if you don't sell to another company, you want to find someone who can take over, and at least as a second position from working with the buyer of the company. And that person doesn't walk in off the street and automatically know how to run your business. So you need to coach them, you need to train them, you need to find them. So that takes time. So there's a process, and 1,000 days is a pretty reasonable number to keep in mind as you're thinking about exiting. But today's presentation is about 2026 because many of you already done this. You're ready to sell now, and we can help. So our services include, as I've just described, what we call exit value coaching, which is that exit preparation process. We do M&A advice. We do business valuations. It's always helpful to know whether your business is what it's worth and whether it's at a stage in value that you can comfortably afford to retire. Is it going to bring you enough retirement savings? And then our intermediary transactions are both, as I said, both sell side and buy side. So the topic today is selling your business in 2026. And what we think is what the M&A market is happening this year. So we're going to cover, is it a good time to sell? We think it is. What buyers are paying for companies your size in that 2 to 20 range, 2 to 30 range. What it takes to get under an LOI to actually get a verified offer that allows you then to go through the purchase order process, agreement. And then the 3 actions we'll talk at the end about what you should be doing before you go to market. I want to make note here, most of the content is from a presentation from the National Winter 2026 M&A Market Survey. It was done by AMNAA organization. It's an M&A organization of providers like ourselves. And they surveyed 2,000 deals in the last year. And the data that we're presenting is what they found in their analysis, and what 2026 looks like, especially in Q1. Deal volume. What we think is, I use the term cautiously optimistic. 2025 started off very well from our perspective, and then it flattened out in the summertime, and it kind of drifted to a close. So we're cautiously optimistic for this year, not doing that again. I think it's going to continue through the end of the year. The factors that came into play last year are not going to repeat, I don't believe. One was certain uncertainty related to tariffs. Another one was related to what's going on in the Middle East. It kind of put a color on things, and it just the lack of the interest rates were high as well. Just a lot of things were kind of making it difficult for people to make the commitment to sell. So now they're still there and they're still looking to sell. So right now, this is from the data I was mentioning, there are 219 active deals under LOI already for Q1, and they roughly 5.39 billion in value. The baby boomers basically own many $1 trillion worth of businesses. So there's a healthy amount of opportunity to sell and for companies to buy. So multiple expectations. We're confident that things are going to pick up very quickly this year. We're starting to see our pipeline build. So we'll wait and see, and business owners should be, we think, prepared to sell this year. So what does the data tell us? Transaction values of if a business is under 4 million in TEV, the multiples we've seen on deals we call Main Street, they generally will range between 4 and 6 times their earnings. When the business is a little bit bigger, if they're over 4 and under 10 million in earnings, then it jumps to 5.3 to 6.1 range, a little bit more. But really, the businesses that have value of 10 to 25 million generate a much better return. So they generally up to 6.9 average multiple sale. So as businesses get bigger, they can become more valuable. It's a simple matter of reducing risk. A bigger company is less likely to have little things affect it. Losing a customer, having a employee leave that's a key employee, etc. There's this, if you're not big enough, there's always a risk factor that a buyer will explore it with due diligence. So the active deals so far in the pipeline are looking like they're going to see the long-term averages. What the data shows is B2B business services are the most active. It's kind of a shift. Last year, it was interesting. A lot of the most active were in the healthcare because that's an industry that's always growing. But the B2B services have rebounded. Manufacturing, I think there's an anticipation of recovery in the U.S. Of manufacturing businesses. So there's a lot more interest in companies buying certain manufacturing businesses that add to what they're already doing, kind of a leverage buy with improving on their return. We are very active in construction materials, construction in general, managing larger commercial construction especially, and it's a very active market. And then these specialized services, professional, technical, and scientific services are they're always there. There's a lot of employment in those categories, so there's a churn. So we think those are hot industries in 2026. So how are these deals being structured? There's a lot of variation. Every deal is different. Every deal has its own merits based on the buyer seller reaching an offer, the LOI. We see and we encourage transactions that have at least 75 to 80% of cash at close. We try to, one of our strong points, I think, is encouraging our clients, our seller clients, to not accept offers where they have so much of the value of the transaction at risk, where they're not getting much cash up front at close, and then they're hoping that the whole thing works out to everybody's advantage going forward. They build a life on their business life on having a successful business. You should expect to get 80% of it at the closing date. There's a certain amount of escrow needed. The buyers want to protect their interests a little bit, so we'll see, on average 4 to 8% of an escrow holdback based on certain conditions. Sometimes it's a seller note, and other times it's an earnout. Earnouts, if you're not familiar, are predicting the future earnings and having effectively a wager on achieving the results. The buyer is saying that if you achieve these results, I'll pay you for those results. I'll pay you more than I paid you at closing. So that the 20% that's not in cash received at closing can be held back and paid over a 1 to 3 year time period based on achieving the earnings that are predicted. It's a way to bridge a gap too. A lot of times the seller wants a certain amount for their business, and the buyer doesn't think it's really worth that amount, so they'll put an earnout in there to say, if you achieve these results, I'll pay you more. So that we see that a lot, and seller notes or any third-party loans are declining in most, except for larger deals where there's a thing called mezzanine loan. Let's get the word out. A mezzanine loan is sometimes backed up in private equity deals where the buyer has borrowed a lot of money to make the offer because they don't want to put all cash into the deal up front. So there's a lot of management around that financing of the opportunity. So this is an important comment. What gets you under LOI? What are the factors that achieve a successful letter of intent? Certainly, the business has to have revenue consistency and predictability. If it's not predictable, because buyers are buying the future, they're not buying what you're presenting as the past. Most the data when we present our clients' business. We present with data of the last 3 years, the P&L and the balance sheet from the last 3 years. But that's history. The buyer wants to know what's going to happen in the future. So they can only judge that based on a certain amount of consistency and predictability in clients and in the market in general, or the industry that they're working in. If those are how the buyer can make a decision on making the offer. A strong EBITDA margins are important. They vary by industry sometimes, but if you have a strong EBITDA percentage, if you're not familiar with earnings before interest, taxes, and depreciation and amortization. That's the mouthful. So that's the measure of profitability. And if it has elements of potential growth, that's important for getting a good LOI. Management strength. A factor that comes into play is, these are deal by deal. A lot of times the management team is not part of the negotiations, although sometimes they can be, where they're brought in under non-disclosure agreement. So the buyer has a feel for the team that the owner has organized over time. So they want to have confidence that the management team is going to be there and continue on, so that the owner can walk away. One of the most difficult things, especially in smaller companies, is the owner dependency. That's the 1,000 days I talked about earlier. That's a time when you got to reduce the owner dependency, because it's a big negative when a buyer realizes that the owner is needed for the success of the business. Could be related to certain customer concentration, that the owner knows the customers personally, or it could be technology that the owner has developed personally and has patents or something, or it could be just the overall function of the business and the marketing. All decisions go to the owner's desk. That's a tough one to sell. So the management team is important, and the owner has to make the business successful without the owner's personal involvement. I've said this many times and been doing this a while. You're ready to sell when you went on vacation for a month and no one knew you weren't around. If you were on vacation for a month, no one knew you weren't around, didn't come to, hey boss, can you approve this or that? Then the business has potential for selling, because it can run on its own. And certainly that low customer concentration, because that's a huge risk factor, especially if it's linked to the owner. If these customers are personal connections of the owner, convinced them to become a customer years ago, and they've been consistent and loyal customers. And if the owner is leaving, does that customer start questioning, should I check and see who else can do what you were doing for me? What other suppliers are out there? So that has to come into the mix. You got to have a broad customer base that gives you a little bit of protection from customer turnover. So these are all factors that seriously can help or impact an LOI. The corollary is what I was just talking about, is why deals fall apart. Seller preparation is very important. And the seller example, the seller doesn't have access to a lot of data, like can't find the articles of incorporation, or the financial P&L is packed full of personal expenses or one-time expenses that can't be pinned down to why they were necessary, what caused that expense. So it's the weak or missing data that goes into not being able to, for the buyer, not being able to understand how the business operated and how they can take it over and continue that success. And certainly negative discoveries in due diligence, that sometimes could be a hidden lawsuit, and it's hidden from the seller sometimes. They didn't know this person was claiming injury and was filing actions with the the state to get recovery for being injured on the job. Well, if that comes up in due diligence, it can be a very harmful factor. In addition, there's the due diligence is another thing that I think becomes important in that 1,000-day period. You can do your due diligence carefully over that 1,000-day period without alerting the company, the employees, to what's going on, because you have to really look for things and dig and organize the data and the documentation. And if it's obvious that you're doing it for a purpose of selling your business, that puts people on alert and might cause some turnover and so on. So the 1,000-day period is helpful in making sure that the due diligence is organized and it's easier to present to the buyer, that everything's there's no discoveries that are going to be coming forward that you didn't already know about and cannot explain well. And I've already talked about owner dependence. That's so important. And then, I had occasions where deals have gone bad because literally the owner decided, no, I have the business on the market. I don't have to work as hard. I don't have to go and he was doing a lot of this personal selling and had all the customers related to him. And so he took his foot off the gas pedal, and the business for the due diligence can take 90 days. So during that 90-day quarter, the revenue dropped off, and the buyer goes, what's going on here? And the owner stopped selling, didn't put a lot of the effort into maintaining the growth of the business. So it's actually in the last 1,000 days is when you really have to work hard to make the business grow, not let it slide. So those are all factors that deals fall apart. So let's talk about things that we can point to that the moves you can make to address the issues I just described. Certainly clean monthly financials with clear add backs. If you're not familiar, an add back is a one-time expense, effectively, or a personal expense that you're going to not have going forward. You're going to clean it out of the P&L. They're not needed for the business to continue forward, so they get added back to the bottom line to improve the picture, but they have to be well defined. So you have to, and you should actually remove them most of the time. If a business has lots of add backs, that's a question by itself. You got to document your processes. Again, as I was just saying a minute ago about doing it in a kind of slow pace, because if you're trying to hurry up and document everything and define all your systems in the last 60 days before you go to market, that's an alarm bell. So you need to do this over time and get the business organized so that you can turn it over to somebody without you having to be there any longer. You need a bench. It goes back to what I said earlier also about having that second replacement that you can train, and finding that person, training that person, and delegating to that person. It takes more than 30 days. So you need to have that timeline to get the business out, to prepare the business for when you're not there. And obviously documentation around customers and vendor contracts. People don't always remember that vendor contracts are important. There are certain industries that vendors are necessary, and if the contract is with the business and the business changes ownership, because I'll explain a little better. When you're selling a business, you're selling most of the time the assets of the business, not the entity itself. And the vendor contract would be with the company, the entity, the LLC or the Inc., the incorporated company. And so the assets are sold out from under that organization, and the vendor contracts are stranded because you got to now go back to the vendors and reestablish the contracts. The new owner will have to do that. So it complicates things. So you got to really understand who your vendors are, what the contracts are, and in some cases you may want to sell the entity instead of the assets, which is a different legal process. Especially in this age, AI is so important. I don't think most of us go through a day without some interaction with AI. Most of this presentation was done with kind of a curation using AI. And certainly technology is always changing. So just the fact that AI is so quickly come on to changed the business cycles in the last 3 years. It's going to be more changes going forward. So you need to prepare for the technology disruption and know it's going to happen in your least prepared area. So you have to think about where are the areas that you have risk factors. You got to, automation is important. As companies invest in U.S. Factories and business entities, automation is becoming much more a requirement. And finding good employees has always been a problem, and that can be somewhat solved with good automation. Documentation, I talked about earlier, every business process has to be documented to the degree that someone can understand how you did what you're doing and why you're doing it, and who's the beneficiary, and who are the needed employees that run that process. So everybody has to understand the documentation of how your business operates. And then, as is always the case, as I said earlier, businesses are buying the future, the buyers are. So if you need to be able to talk about what, if you were to stay on, what would you do? How would you run the business in the future? What are the things you think are important? Now, I've seen many times over the years, somebody will say to me, well, my business has a great future. I should get extra value out of that. And the actual answer is no, you don't get value from the future. The buyer gets the value from the future. That's what they're buying. But if you can't explain the future and give a comfort factor to the buyer that you have a credible opportunity going forward, then you won't even have a sale. Nobody will buy it. Your business is going to be stranded. So it's important for having a successful transaction, but it's not going to add real value in the ultimate transaction, because the buyer wants to maintain that leverage for their gain as they go forward. I went one too many. Previous. So the third component of move 3, the moves we talked about, is what is needed for this year and next. As you know, I said earlier, baby boomers are the heart of our market. There's a huge number, literally trillions of dollars in value owned by baby boomers. But it's not oftentimes understood by even the U.S. government doesn't understand how much of the U.S. economy is based on baby boomer generation business owners. It's huge, and so they're reaching a point in time and age that they need to think about their exit, and so it's going to drive a lot of the motivation. And as time goes on, I've seen it a lot of times too over my many years. Age, it saps energy. Whether it's injury or illness or just tired, you're just tired. A business can start drifting downward if you're waiting too long, and there's no time like now to sell. So you got to think about it in terms of you can't wait. Next year may not be better than this year. So there's no time like now. Just it's important that you think in the near term. The favorable window of opportunity is now. I just keep repeating it because there's a lot of shift from last year. Buyers are still out there, and a lot of money on the side, especially in private equity as well. And the interest rates are down a little bit, so that's going to help any bank loan that's coming. So it's a confluence of timing. Is 2026 is the year, and then we don't know what the future holds. Tax and economic shifts may reduce future multiples. We don't know. We know what they are now, and they may be for a few more months the rest of this year. But beyond that, there's another election next November. So between now and November, there's no time that you this is the safe period of time to make this decision. So I was thinking this would be a 30-minute presentation, and it is. Our final statement is take the next step. We can help. schedule your sale readiness checkup with us. We offer a 60-minute confidential session to benchmark your business and identify your top 3 value boosting moves. We have expertise in doing this. We're doing it long enough, and 99% of our clients are selling the business for the one and only time. We sold many businesses, so we know what the process requires, and we know how to provide the best advice. So, that's all I have to say. I will open up for questions, and I'll introduce our CEO, Klaus Madsen. So I get this back over here, and stop share. And there's Klaus. So we're ready to answer any questions people may have. It's an important decision.
Yeah, Paul, we got one question in here.
Okay, I see Q&A.
Yeah, that actually asks here, given what you've shown about the 26 and 27 being a key window, how should I decide whether to start a sales process now versus waiting a couple of years? Specifically, I'm a small MEP company like mine. I only do 2 million in revenue.
Well,
what would you tell him?
Yeah, it's less whether you're 2 million or 30 million. It's more, as I said in one of my slides, I talked about you never know what the future is going to be. So if you are waiting, and again, I keep going back on history, 2021, I remember very distinctly when the country shut down because of the pandemic. And I know many businesses went under, they especially in food service business and restaurants and so on, but others were harmed because if you were an importer, you had trouble getting your products into the US, et cetera. So who knew that was coming? So there's like, you can't wait for the next month, the next year. There's no time like now. So the best answer I can say is, if you think your business is ready, we can help you go to market. If you're not sure, we can help you by scheduling a conversation with us. We can let you know what we think you need to do to make the changes that are get it ready. Sometimes it's analogies help. Sometimes it's like trying to sell your house and you know your roof is leaking. Well, maybe you want to fix your roof before you put it on the market, because the buyer is going to say, I got to fix your roof. So that's kind of what we can do to help you get ready.
Yeah, and maybe we should also mention, I mean, we do get a lot of questions now when everybody is reading the headlines of what's going on. The uncertainty, the war, increasing inflation, what's going to happen to the interest rate, which of course all focuses and affects business exits and multiples. Yeah. But let's also look at, and we haven't had a recession since 2008, so that's 17 years. And as Jimmy Dimon says, a recession is something that happens every 7 years. So you can say, okay, there is something that is about to happen. Well, who knows? But when you look at your own on a business exit, I mean, even in bad times, businesses are being sold. Because when it comes down to it, remember, it's not about headline stories. It's about fundamentals. That means your consistent, predictable revenue and margins. That's number one. Is your management team strong and doesn't depend 100% on you? And are you not too concentrated with your clients? Though, if those 3 areas, well, then you can actually move forward in any situation and you will get truly good results out of that. Because remember, the 5 questions that you always have to ask yourself in such a process is sort of, okay, why do I want to sell? When do I want to sell? How much do I want to sell? To whom do I want to sell? And is my cash enough? Now, this is not sort of a checklist. This is more like a small decision system rather than a checklist, because one can affect the other. But you should look at those questions, and the most important one of those is your why. Why do you want to act? If you're not sure, don't sell. don't do anything, because then you're going to have seller's remorse. It's as easy as that. But if the
Well,
why is there,
you're not sure
well,
though,
you
we can
invest.
help you become sure. That's
Exactly.
our exit value process. It's
Yeah,
helping you build value so you when you do go to market, you're comfortable that the value is there and this is the right time.
exactly. Exactly.
Norman has a couple questions. I don't know if you see. How does business category and EBITDA factor into valuation? And secondarily, how can the business structure impact a sale? We are currently an S corp, considering a reorg for a QSBS of future sale. I don't know what QSBS is, but those are the complicated questions. First of all, the first part of the question is the business categories. Every business category has different multiples, but they don't change a lot. What the biggest factor in impacting the value of a business, literally, is the earnings, profitability. If a business has enough profitability, it's going to be worth more, regardless of industry. But one of the common examples is if the business has recurring revenue from contracted customers, like a lot of online businesses that sell service online. They have customers, you give the credit card, they could every month the credit card's charged. That has a little more value because it's very predictable. And compare that to a company that does construction, and you have to make a bid to get a project, and how often do you have opportunities to win those bids? So that's more risk on it. So those are most of the variables, but there's that the EBITDA is a certain factor, but that as noted, it depends on the industry's multiples, and the EBITDA are. I'm talking to circle, but I want to make one more point because this we get asked a lot. The general methodology for valuing a business is to develop a curve, a bell-shaped curve, and use the median of all the transactions related to that same industry. However, if there's a bell-shaped curve, there's some on the high side and some on the low side. Well, why are they on the high side? Because it's not just the earnings that reflects on the median. The companies that are on the high side of that curve had other factors that impacted the value. And on the lower side of the curve, they had negative factors. It could be the customer concentration. It could be their technology is old. It could be they're in the wrong market. So there's lots of factors that move the curve from the median. The median is just a methodology for establishing a target. So I don't. Do you have an answer to the S corp question, by the way? Klaus, do you want to answer that?
No. The what? I didn't get that.
He asked the question about how can the business structure impact a sale? We're currently an S corp, considering a reorg for a future sale. So,
yeah. No, but I mean, the best thing there is, I mean, speak to your CPA and your tax advisor, because there's so many factors that goes into that it's difficult for us to say what is best, because you really don't know until have all the details and dig down in your history of investments, assets, depreciations, and so forth. So I would rather not be specific here and just refer that. We do work with consultants that know about this. So if you want references for that, we're happy to share.
Yes. Yeah, it is a little bit complicated. I know for a fact that the Big Beautiful Bill affected some of the decisions on S corp versus an incorporation because of the tax issues there. They changed the tax issue for the business, but that's where the CPA comes in. We're not experts in that, in taxing. Any other questions?
No, I haven't gotten any more here. I think we're good.
Oh, there's something in the chat. Oh, it's the same one, same question. Okay.
Yeah, we're good.
Okay. I guess that's it. If no one else has a question, I thank everyone for their time today. Hope it was valuable, and please take us up on our offer to have that consultation. Um, we can provide good advice, whether you take it or not. It never hurts to ask. So we'd love to work with you a little bit.
Thank you.
Thanks, everybody.